In today's video, I want to go through an article that I came upon recently that talks about a couple of economic indicators that point to a really bad future, short-term future for the stock market. And the purpose of this video is to remind you to plan, don't predict. And I'm going to not only show you the article and some of the highlights from the article, I want to give you some context around the history of the stock market, but then I specifically also want to give you the tools that you need to understand how you can protect yourself if you're getting ready to retire and you're worried about a market decline at the same time. Because we all know that if you're taking money out of an account that's falling in value, that's like being stabbed and going to donate blood at the same time. It's a bad situation, and we don't want to make things worse. The key here is we want to plan, not predict. And I'm going to take you through this article. Maybe you've seen it. If not, I'll include the link in the show notes below if you want to read it in its entirety. Okay, so this was an article I saw in Yahoo Finance. The Motley Fool is who it was written by, Sean Williams at the Motley Fool. And the title is U.S. Money Supply is Making History for the First Time Since the Great Depression. And it implies a big move in stocks is on the way. And I'm just going to hit some of the highlights here. So over lengthy periods of time, it's tough to outpace equities in the return column. However, the predictability of directional moves in the short term for the Dow Jones and the S&P 500 and NASDAQ gets thrown out the window when the time frame is narrowed. It doesn't stop investors from trying to gain an edge. A couple of data points and indicators do have exceptional track records of correlating with moves higher or lower in the broader market. Among the 5 money supply measures, 2 receive the bulk of the attention from economists and investors, M1 and M2. And he says the U.S. money supply hasn't done this since 1933. But on rare occasions, U.S. money supply contracts in a big way, and that historically has portended bad news for the U.S. economy and the stock market. This is the first significant drop in M2 since the Great Depression. Then again, history has been incredibly unforgiving when M2 money supply has fallen by at least 2% on a year-over-year basis. The previous 4 instances all coincided with deflationary depressions and double-digit unemployment rates. About 2/3 of the S&P 500 max drawdowns occur after, not prior to, a U.S. recession being declared. In short, a persistent decline in M2 money supply could spell trouble for a currently red-hot stock market. Before we go on to the next bit of bad news that he shares, I just want to talk about the fact that our brains like to create patterns, and we recognize patterns, we understand stories, and so when people take patterns and combine stories and put them together, especially in historical context, it can be very compelling. So the next piece of bad news is, he says, another key moment based on data point that is cause for concern is commercial bank credit. And he goes on to say, since reporting the data began in 1973, there have only been 3 instances where commercial bank credit has pulled back at least 2% from its all-time high. In October of 2001, during the dot-com bubble, commercial bank credit slipped a maximum of 2.09%. In March 2010, shortly after the Great Recession, commercial bank credit troughed at a 6.94% decline. And then in November of 2023, commercial bank credit hit a peak drop of 2.07%. For context, the S&P 500 lost around half of its value during the previous 2 sizable contractions in commercial bank credit. But just as history can at times serve as a short-term guide that portends downside in stocks, it's often the greatest ally of patient investors. Now, this is really a key. So he starts out talking about the Great Depression and M2 money supply, and a contraction in the money supply could indicate that stocks are in trouble. And then he talks about this commercial bank credit and how that could cause problems for stocks. But then he finishes the article in the light that I think most of us are aware of, which is over a long period of time, time being the key here, time is the cure to the volatility of the stock market. The more time you have, the more risk you can afford to take. I like the quote by Warren Buffett where he says, forecasts can tell you a great deal about the forecaster. They tell you nothing about the future. But the fact is, once you head into retirement, you need to have a good plan, a good strategy, so that you know how to deal with market volatility, because market volatility is a normal part of investing. So let's take a look at a couple of things to bring context to the potential for bad news. The first thing I want to bring to your attention here is that negative is normal. volatility is normal. It's not always healthy, but it's normal. And what this chart is showing us is a distribution of U.S. market returns of the CRSP 1-10 index returns by year from 1926 through 2022. And what you'll see is that 74% of the time the market has been positive, 26% of the time the market's been negative. So based on this data, if you were to ask me what do I think the likelihood of the market going up or down this next year, I would tell you probably about 74% of the time it's going to be up and 26% of the time it's going to be down. We just don't know which specific years. The next thing I want to remind you of is that markets have rewarded discipline. One of my favorite quotes is from Jim Rohn. He says, "All men will experience pain, the pain of discipline or the pain of regret. The pain of discipline weighs an ounce and the pain of regret weighs a ton." And I think what we experience a lot of times, or at least what I see, is people get nervous, they read an article that talks about the bad news, they sell, they go to cash, they miss out on all the market recovery and all the market returns, and then they have to live with that regret. Discipline, when it comes to investing, is your friend. You want discipline in your life. And this just goes to show you that if you're looking at the MSCI World Index from 1970 through 2022, there have been a lot of headlines that have been negative over the years. And you can see $1 invested grew to over $80 if you were patient, disciplined, and you stayed the course and you didn't let these forecasts or predictions throw you off course. And then this last slide that I wanted to bring to your attention just emphasizes the point that reacting can really hurt performance. And this is looking at the S&P 500 index from 1990 through 2022. If you had invested $1,000 back in 1990 and just held it the entire time, that $1,000 is now worth $21,555 at the end of 2022. However, if you missed the 5 best single days, instead of having $21,000, you only have $13,614. So playing this game of trying to get in and get out at the right time because you're worried about market volatility or risk can really hurt you. So the next thing I want to do is I want to show you from a retirement planning standpoint, how do you construct a portfolio that can weather these storms? Because ultimately what we need you to do is stay invested through the good times and the bad times. So let's look at a strategy for accomplishing that. Okay, remember the emphasis of this video is to plan, don't predict. Anytime you see an article that's trying to make a prediction about what's going to happen in the short term, we want to focus back on the plan that we've created. So I'm in the retirement budget calculator. I've created a very simple plan for this couple. And you can see the green line is the year of retirement. In 2026 at 63, they're going to have his Social Security, her Social Security, and a small pension. So they're going to have $54,000 a year of income. But their budget requires $101,000. Now, one of the things that we did was totally different than the rest of the world when it comes to retirement planning, is that we put all of the emphasis on your spending, because if we don't really understand your spending, it's impossible to understand if you've saved enough to be able to retire with confidence. So in this case, you can see their spending is $101,000. We detail that up here in the budget data tab. And you can see they're going to have a shortfall, $53,397. We assume a very conservative rate of return on their money. So 0%, 2%, 4%, 4%. So we know that they're going to have to be pulling $36,000, $53,000, $55,000 out of their investments, out of their cash, out of their retirement accounts when they first retire. And those distributions are going to continue. So the question becomes, how do you deal with this potential for short-term bad news in a good financial plan? And that's where the buckets come into play. So you'll notice in the buckets tab, what we've identified is we've got short-term money that's going to be needed for income in the first 3 years of retirement. Then we have money that's invested conservatively. So this is money that's going to be needed in years 4 through 6 after you retire. Then you've got $203,000 that's invested for years 7 through 9. So we have a little bit more time so we can afford to take a little bit more risk. And then in their situation, it leaves $987,000 that we know that we're not going to have to touch until the 10th year. Again, time is the cure to the volatility of the stock market. The more time you have, the more risk you can afford to take. Now, my belief is that rather than just having, say, bonds in a second bucket here, what I think makes more sense is to have a diversified portfolio, probably tilted more towards fixed income and cash for that short-term bucket, But rather than just having one asset class, we can be broadly diversified across asset classes, sectors, across the entire globe for each segment, and then rebalance each segment as we transition through retirement, because we know that rebalancing is a risk mitigation tool. In summary, the key is you want to plan. Don't predict. Don't try to forecast. Anytime you read something that's negative in the news, go back to the financial plan that you created and just look at, start stress testing it. Look at what happens if somebody gets sick. What if somebody dies early? What if you end up having a bigger expense than you had expected? What if the stock market doesn't perform as well as you expected it to? And what I find is that when you work from a planning perspective first rather than a prediction perspective, it just gives you a lot more confidence to be able to weather the storm, stay invested, stay disciplined, and be a good investor, a good steward of these resources for the long term. I hope you found this helpful. Thanks so much.